Hey, good afternoon, everyone. How's everybody? Hey, good
Hello,
afternoon.
Professor.
Good afternoon.
Good afternoon. Good afternoon, Claudia, Braylon. All right. So I see 7 people here in the collaborate session. Let me briefly look at how many are in the. Okay, and please don't forget to sign into the forum, right? I see also, 8 people here in today's forum. So I should see one more person, and he's joining, I believe. Okay. So it's been quite a while because of the spring break. I don't need this. So let me quickly let's quickly review, right, what we did before the spring break. Basically, what we did. Not this one. What's going on? So before the spring break, right, what we did was basically bond pricing, right? Bond valuation. In other words, coupon bond, especially coupon bond. The bond pricing formula for coupon bond is basically coupon payment over R minus coupon payment over R times 1 plus R raised to N plus face value, right? Face value is always $1,000, right? 1 plus R raised to N, okay? And what you should also remember, bond is on a semi-annual cycle. That means, right, M is 2, right? That means, this N is 2 times T, right? If the time to maturity is 10 years, right, N will have to be 20. And also R is APR divided by 2, right? Is there a better way of writing this? Because it's on half-year cycle, right? So keep that in mind. And also, this much is the present value of annuity, right? And this is the present value of just a single cash flow, right? Okay, this much is the present value of annuities. And this is the present value of the single cash flow, right? Now, with that keeping that in mind, let's do this example. Where is the example? Okay, here. This one. So the Emory Corporation issued an 8% 25-year bond 15 years ago. So what does this mean? I mean, it's not difficult to understand. This is the coupon rate. This is the coupon rate. 25-year bond, but that was issued 15 years ago. So what does that mean? Time left to maturity is now 10 years, right? Because, that was already 15 years ago, right? And at time 0, it had at time 0, it had 25 years left to maturity, but now it has only 10 years left. And at the time of the issue, it sold for its par value of $1,000. Now it sold for $1,000 par value. You remember the bonds fall into either bond, right? Bond price can fall into either, right? It can be either greater than or equal to or less than, right? Par value, which is 1,000, right? And from, we've done this so many times. If it sells above par value, right? If the price is above par value, then that's called a premium bond, right? If this is the case, then premium bond. And if this is the case, it's called discount. It's called discount bond. But if the price is equal to $1,000, right? Then that's called, there's no name. This is, par value bond. It's selling at par value, right? And we talked about this so many times in our previous classes. What makes the bond a premium bond? And what makes the bond a discount bond, right? Does anyone remember what's the reason? Does anyone remember? And I talked about, cause and effect. Does anyone remember what makes a bond a premium bond? No one? It's so awfully quiet. I have, how many people in here? I have 11 people, and everyone is so quiet. Anyone? No one remembers? Okay, Claudia, are you there? Lorraine, are you there, Lorraine? Can you guys hear me? Maria, are you there? Looks like nobody's here.
Yes, I'm here, Professor.
Okay, Lorraine, do you remember? Can you answer my question? Do you remember that? What makes a bond a premium bond?
Premium bond? Oh, I don't remember.
Well, please, this is, what should I say? You get -5 points for not being able to answer that question. Okay. Maria, are you there? Maria? Nikari, are you there, Nikari? Okay. Tia, are you there, Tia? Okay. Sapphire?
Yes, thank you.
Okay, Tia, do you remember that? Okay, you heard the question, right? So what makes a bond a premium bond?
Doesn't it have to do something with the face value or the face amount of the bond?
Yes, but that's not what face value is always $1,000. So it has nothing to do with the, yeah, it has something to do with the face value because it's relative to whether it is greater than, I already explained.
The interest rates. The interest rate.
Oh, say that again?
The interest rates are
Oh,
higher.
Professor. Yeah, that's what I was gonna say.
Yeah. But what interest rate? I mean, interest rate higher than what?
Than the
Is it because
market
of the face
interest.
value? Like the face value is higher when we have a premium bond?
No. Who was this? Lorraine?
Yeah.
No. Let's have Tia answer the question first, okay? So Tia, go ahead.
You said which interest rate of that premium bond is higher than, and it's higher than the market interest rates.
It's higher than what?
The market,
Market interest rate? So which interest rate is higher than the market interest rate? What are you? So which
the
interest rate are you
premium
talking about?
bond.
Yes. Hmm. Okay. So the interest rate you're talking about. So which one is the interest rate? Is okay. So interest rate on the premium bond, right? Interest rate on so if I rephrase it and summarize it, what you're saying is that the interest rate on the premium bond is greater than the market rate, right? That's what you said, isn't that right?
Yes.
Okay. Yeah, roughly it is correct. Okay, but to be more exact, um, it's the
Oh,
coupon
Professor.
rate coupon rate of this bond. If this It's always the question of whether uh, the coupon rate is greater than or equal to or less than. Okay,
Than
so
the
if
par
the
value, right?
huh
What you're saying that lower, equal to, or higher than the par value, right?
no, no you how
No,
can you compare interest rate with a par value? Par value is
no, I'm talking
dollar.
about the zero coupon bond.
No. This is the
So
coupon rate, right? This is the coupon rate. If the coupon rate is greater than what? The coupon rate is greater than, you said market rate, market interest rate, right?
yeah,
You said that in your own words, right? From your own mouth, you said the interest rate on the bond is greater than the market interest rate. And that's what I summarized, right? From what you said, that's how I summarized it. So you have to get it in a very steady, firm way. You have to state it in a firm way. You shouldn't be, if you're getting, if you're switching between this and that, if you're just flipping over, then that means your mind is not firmly on that thing. It has the language must be in a firm, steady statement that doesn't change. And for that to be, for that to happen that way, everything must be clearly defined in your mind. So if the coupon rate is great, so coupon rate is what the bond pays, right? Coupon rate is what the interest rate that the bond pays. If the coupon rate is greater than the average market rate, that's what this expression means. Coupon rate is greater, right? Greater than the market rate. Then it becomes a premium bond, right? Because the demand for this bond will be very high, because this bond is paying better, right? Better than the average market, right? So because of this strong demand, the price will be pushed up. The price will have to go up. It goes up even above the par value. I mean, then So Tia, you're going to get 0.5. Then the opposite is true. If the coupon rate is less than the, let me rewrite this, greater than, equal to, less than. If the coupon rate is less than the average market rate, then it will become a discount bond. And then the only thing left, if the coupon rate is equal to the market rate, then it will be a par value, but it will sell at par value. It will be exactly $1,000. There's no, so from that we can tell, back here, it said when it was issued, right, at the time of issue, it sold for its par value of 1,000. So what does that mean? That means at the time, that was 15 years ago, right? At the time when it was issued, right? At the time, right? At the time of issue, the interest rate was also 8%. We can't, right? We can guess that. We can, right? At least we can make this educated guess that 15 years ago when it was issued, right? The average market rate was also 8%, right? Otherwise, it couldn't have sold for $1,000 par value. However, comparable bonds are yielding 10% today. Comparable bonds are yielding 10% today. So what does that mean? What does that mean? Comparable bonds are yielding 10% today. What does that mean? That means the discount rate is 10% now. Okay? And I've been telling you this over and over. This is the way it is worded. They don't say, I've been telling you so many times that they don't say use this as the discount rate. They never say this is the discount rate. Okay? They never say this is the discount rate. 3 ways it is worded. I've been telling you this over and over. 1, the bond is price to yield. Price to yield X%. 2, the comparable bonds. Comparable means, or similar. Similar bonds pay or yield, X%, right? 3rd way, prevailing market rate. Right? These are 3 ways it's worded. The problem is worded in general. Comparable means, I've been also going over this so many times, it means the bonds of the comparable risk class, right? If this bond is a triple B class, then on average, other triple B bonds are paying X%, right? Because other risk class, right? Single A or double A, it doesn't matter because this is triple B bond. If this is triple B bond, what matters is what other triple B bonds pay. Okay, so that's that's 3 ways. The wording, that's 3 ways that the wording, how it is worded, right? The wording is, so when it says comparable bonds are yielding 10% today, that means that is the discount rate. Okay? And you might oh, so, and people who are not listening, who have not been listening, might say, oh, well, Professor, you're saying R is 8% there and R is 10% now? I mean, what is the R then? Well, R is 10%, of course, because this one, this is 15 years ago, right? At the time of issue, right? When it was at time 0, right? This is at time, this is now, which is time 15. I hear a lot of, background noise. So please, if you're not speaking, please mute your microphone. So in other words, we are at time 15, right? This is so we have everything we need. What must Emory's bond sell for in today's market, right? To yield 10%. What does that mean? This means this is the discount rate. Okay, so let's do this. And this is a two-part question. Part A. First, what's the price? And second, bonds current yield, right? It's asking for first, what's the price, right? And what's the current yield? So I'm going to get to current yield later, but let's open this file. I mean, you should have this file already. If you have this file, you should have, from our last class, you should have downloaded this already, right? You should have it. So I see like 13 people here, but I see 11 people. So 2 are still missing.
Professor, I accidentally signed in twice.
You accidentally signed in twice? Okay, that will
Yeah.
be okay. Thank you for letting me know. Yeah, that will be checked later because as I will sort it in alphabetical order, and then it comes up, right? So don't worry, I'll just delete the second one. Okay. All right. So where was I? So from from our course material folder, topic 4, right? This file, right? And you downloaded it last time already. So if you download it, right? If you have it in front of you, right? Let's see. I think we already did a couple of examples last time, but let's say this is the one. So because we have to answer the current yield as well. So first of all, we'll need to make a little adjustment because face value is 1,000 always. Coupon rate in this example, that was 8%, right? Coupon rate was 8%. So the coupon payment is $40. You all understand because annually it would be $80, but half year, right? Half year, it will have to be $40. And the time remaining is 10 years, right? Remember, it was a 25-year bond. You see, it's a 25-year bond, but that was already 15 years ago. So we have only 10 years left, right? We have only 10 years left. So then, actual number of compounding is 20 because bond is semi-annual, right? And then this is, the label may look a little, unfamiliar. That's fine, but it's basically, you can tell it's APR. This means yield to maturity. It's APR. This means internal rate of return. That means half-year rate. So, I'll get to that part later. And it was given as, this problem was actually asking for, this should be in the yellow highlight because that's the solution cell, but that's fine. Yield was given as 10%. In other words, discount rate is 10%. Half-year rate, of course, then is 5%. What should be the price? And all we need to do is simply okay, I guess. So it's payment, which is payment is already here. I calculated already. Payment over R minus payment over R times 1 plus R raised to n, close parenthesis, plus face value divided by 1 plus R raised to n. Okay, and hit enter. And the price should be 875.38. Okay, it's 875.38. So yes, of course, that's what you will get. And then the thing is, I should have done it here actually. I only did it because I had. Okay, so let me do it here then again. Let's change this too. And we can tell already. This is one thing we can verify is that this is going to be a discount bond, right? We can already tell that this is going to be a discount bond. Why? Because the coupon rate is less than the prevailing market rate, right? That's why it's going to be a discount bond. Next, the sign is incorrect. I'm going to have to. Coupon rate, what's the current yield? What's the current yield? Current yield is basically annual coupon payment divided by the price. Okay, that's the coupon rate. Current yield. I keep saying. So what was this? What was the original problem here? I forgot. So I'm gonna have to. I'm gonna get to that later. Maybe 3%, wasn't it? I'm going to get to that later. So now, so here's the thing. What is I'll just give you straightforward that the current yield oops. current yield, and yield is annual coupon over the selling price of the bond. Okay, now yield means annualized return. Remember, yield is just another name for annualized return. That we talked about this already. The current yield is current yield is the return you can earn, maximum return you can earn in a year. Okay. Yield is just another name for annualized return. But when we talk about yield, there are two types of yield. Current yield and yield to maturity. So what is yield to maturity? If current yield is a short-term yield, right? Yield to maturity is long-term yield. So yield to maturity is the annualized return that the bond pays you until, if you hold it until maturity. So think about it. In our example, you had 10 years left, right? From today. I don't know if this is 10, 1, 2, 3. Yeah, it happens to be 10. So if you hold it until maturity, annually, this is the return you will get annually, annualized return for the remainder of the time. So assuming that you keep holding it for 10 years until maturity, that's what you get. But then also it is it's the discount rate, right? Given the price of the bond today, right? This is the discount rate. So we can think of it this way also. What is the you all know that the bond valuation formula, you already know. It's nothing new. The price of the bond, and again, I've been telling you this price is not market price, but this is the rational price or fair value or intrinsic value. No space. Intrinsic means this is intrinsic, right? That means there's no bubble, there's no noise, there's no irrational expectations built into this. It's really rationally based on only the predicted future cash flow. And in case of bond, what is the future cash flow? And it's quite obvious. I mean, there is no ad hoc factor, because in case of bond, the cash flow from the bond is quite obvious. Just like the in the house value example, if you rent it out, what is the expected cash flow from your sublease, right? Well, it's quite obvious. It's monthly rents, right? Unless you raise the rent, unless you raise the rent unexpectedly, basically, the rent is fixed for the lease period, isn't it right? If you have 2-year lease for the next 2 years, the rent is fixed. There is no unexpected change. So cash flow is quite predictable, and so a bond is exactly like that. Cash flow is predictable, and there's no crazy irrational unknown variable. It's quite everything is known. So that's why in case of bond, the market price and the intrinsic value are not that much different, right? And if it is, in other words, this is the market price. In other words, selling price of the bond, and they are most of the times they are the same, but it could be slightly off. It could be slightly off, right? But even that slight, what was I trying to? Even that slight difference, even the slight difference is can be the source of profit. It can be the source of making money, by buying or selling, the bond, any asset that is, offline, right? In other words, not exactly in line with its intrinsic value. Something that's overvalued or undervalued, it's the source of profit. So we all know the formula for bond valuation is coupon payment or payment over R times 1 plus R raised to N plus face value over 1 plus R raised to N. And of course, we know this is the annuities, right? The coupon. And then this is the face value, right? Single cash flow. Now, but I can rewrite it. If I rewrite it, I can rewrite it like this. Payment over Y it's payment over Y times 1 plus Y raised to N plus face value. Raised to N. And then you might wonder, Professor, why did you do that? I mean, what's the difference? Isn't that the same thing? Yeah, it's the same thing, but you can tell there's a difference. Difference is some symbols are different, right? Which is this, right? And also B and PB. What's the difference? I told you already. This B is the rational price or intrinsic value or fair value, whereas piece of B is market price. So, in other words, the selling price. And I told you, they most of the times in bond, they are not that, they are closely aligned, but it can be different. But more fundamentally and mathematically, think about it. This B is the unknown, right? In the first equation, B is the unknown. In the second equation, P sub B is not the unknown. It's market price. So this is the price that you just look up, right? You look up the like Yahoo Finance, look up the media, the news media, financial news. You can find, not like the market information, market data in the news media. You can see what the price may be, right? Because as of the last transaction, what was the price of this bond? The price this is the price that you get from the news media. So in other words, this is given, P sub B is given, and in that case, this is the unknown, right? Y is the unknown. So what does that mean? Think about it. In this formula, in this equation, payment was given, right? We knew the coupon payment. Face value is given. R is given, right? The rate was given already. The bond is priced to yield 10%. Comparable bonds are paying 10%. Prevailing market rate is 10%. It's already given, right? But in what is not given is this, B. Price of the bond is not given. So in other words, the right-hand side of the equation is given. The left-hand side of the equation is not given. That's what you need to solve this equation for. That's what you need, right? That's what you need to solve. That's what you need to solve this equation for. Okay? But in the second equation, this is given because it's the data that you can just get from the market, from the news media, from the market transactions, right? And also then, think about it. Coupon is given, face value is given, N is given, right? How many years are left, how many semesters are left. It's all given. Then what is the unknown? The only thing that is not given is Y. Okay? And Y stands for yield. Okay? Again, I use yield to maturity. I said yield to maturity is the discount rate. But this is the annual, lowercase OP, half year. Right? Half year rate. Now think about it. When the left-hand side is given, when the left-hand side of the equation is given, right? This is known, right? And payment is known, face value is known, N is known. Then think about it. There can be only one, the only unknown. This number must be the number that will make the right-hand side of the equation equal to the left-hand side of the equation. In other words, there can be only one number. There can be only one value that can make the right-hand side equal to the left-hand side, right? And that one number is called internal rate of return. That solution is called internal rate of return. Internal rate of return is a mathematical term for that rate that makes the right-hand side equal to the left-hand side. And there can be only one. So think about it. Because the market price is already known, is given, for the right-hand side to the right-hand side is the discounted, the present discounted results, in other words, the present values of the annuities and the present value of the face value. And there can be only one number, right? One discount rate that can make the right-hand side equal to the given left-hand side. And that's called the internal rate of return. So here's the thing. Yield to maturity, they say it is a long-term return, long-term yield, whereas the current yield is the short-term yield. Yeah, not only that, but also mathematically it can be defined as internal rate of return that makes the right-hand side equal to the left-hand side. Okay? Now, as opposed to that, current yield is, I already said that. If you think about it, it's the maximum return you can get, maximum return from holding the bond for 1 year. And what would be the maximum return? Annual coupon is the maximum cash flow from holding the bond for 1 year. Isn't that right? And if you want to hold this bond, you have to pay the market price. There's no other way. For paying this market price, so that's your initial investment, and you will have this cash flow. So this is the cash flow, and this is the initial investment. I don't know. I'm using the highlight, so I don't know if you can see well. I'm sure, on your screen you will also look as highlight. So think about it. It's the cash flow over initial investment. So that's the maximum you can earn by holding the bond for 1 year. Okay, so so the time is, I believe the time is already up. Almost, it's 2:50, 2:49. Any questions so far? Any questions? Ronisha already
No,
left.
Professor.
Okay, all right. Okay, so far it's not that difficult, and hopefully, we'll be able to cover everything about bond, whatever is remaining, on Thursday, and start on, risk and return, so that you can have the quiz too in the coming weekend. All right, so that's it for today. Have a great afternoon, everyone, and I will see you guys on Thursday. All right? All right, take care, everyone.
Thank you,
Thank you,
Professor.
Professor.
Have a good day.
You're welcome. You too.
Thank you.